All right, folks, welcome to Investing for Beginners podcast. Today, Andrew and I, we've been on vacation a little bit. So, we're going to use Fiscal AI today to help us get caught up on some companies. So, we haven't really been paying a whole lot of attention to the market, which it can be a good thing. It can be freeing. Try it sometime. It's actually a wonderful experience. But Andrew and I thought we would talk through some of the companies that are in his portfolio, and we're going to use Fiscal AI today to kind of get caught up on how those companies are doing. Some of them, a few have had recent earnings calls, and a few have had a little more distant time, but still, it's a great experience, and you can kind of see how we can use this platform to get caught up quickly. So with that, let's start talking about companies. I think the first one on the agenda is Microsoft.
Yeah, Microsoft. Everybody wants to hear it, right? Because of
Mm.
AI and what's going on with AI. And how does Microsoft sit? Because if you look at the way that they sit in the ecosystem, they're one of the cloud computing companies, AWS, Microsoft, and Google Cloud. Almost forgot that one. And so as these companies spend on AI, they need this compute. Microsoft's been making a killing. So I'm pulling them up on Fiscal, and I'm going to see segments and KPIs and just kind of see where we are from a quarter to quarter basis. And I know that they just did the 10K. And so the quarterly numbers are there, and also so that means the annual numbers are there as well. Maybe I start with the investor relations page, so we can go. And I think we talked about this maybe a month ago. You can go and you can click in the individual transcript, and you can get the AI summary, and that can really help summarize things for you. So big highlight numbers: revenue up 17%, constant currency. That's crazy for a company of that size. $76 billion, by the way, we were up 17%. Okay, I'll take some of that. Diluted EPS up 24%. Microsoft Cloud revenue, which everybody wants to know about, up 27%. Diluted earnings for the year up 16%. So just when are these high numbers going to stop? Like, honestly.
Right. Yeah, right. I mean, it is a little mind-boggling that a $4 trillion company almost is growing revenues at 18% a quarter. Well, maybe not a quarter, but last quarter they grew 18% in one quarter. That's just kind of nuts.
Yeah. So some of the summary on there: AI driven growth, obviously cloud dominance, commercial bookings surging. If you know the basics of Azure versus AWS, Azure has always positioned themselves for kind of Fortune 500 bigger commercial customers. So the fact that their bookings are up 37%, I think tells you that value proposition that they're offering to. It's one of those things, right? You always want to look for statistics that kind of back up whatever narrative or whatever priorities or advantages that management's talking about. Microsoft has talked about how they see themselves as that solution for commercial, and just to see that up 37%, up 30% constant currency, that's huge. I think it shows that they're executing on their plans.
Yeah, yeah, for sure. And along with that, they did see a decrease in the gross margins for the cloud, and they talked about kind of that really being the impact of the AI infrastructure, primarily. I'm going to guess with the capex spend that all the hyperscalers are starting to double down on. And so it's going to be interesting to see how that plays out in the coming quarters, in the coming years. And I think that's something to definitely keep an eye on. And so it is interesting to see that it did dip a little bit. I mean, 68% is still nothing to sneeze at, for sure. But it is something I'm definitely going to keep an eye on.
You mentioned the gross margin. Talk to us about how that, when you own Microsoft just like I do. So when you talked about that gross margin dipping, what goes through your mind when you see that? How do you interpret that as a long-term shareholder?
It's something that I'm going to keep an eye on for a couple reasons. Number one, it ultimately leads to more free cash flow for the business, which allows them to easily or more easily reinvest in the core part of the business, i.e., the AI infrastructure and the cloud and all that stuff. And if you start to see that start to dip, that could mean that they either are struggling with pricing power with the expansion of AI, or that they're struggling with finding a way to monetize it effectively, or they haven't been. And so that money that they're spending on the capex, the cost of trying to grow and stay relevant in the AI race and the cloud race, is it could potentially impact the profitability of the business, not only in the gross margins, but all the way down to the free cash flow margin. And if you start to see those things kind of slip a little bit, that could be an indication that maybe they're overspending, maybe they overestimated the demand for what they were seeing, or maybe they are lagging in being able to have pricing power. And so those are some of the things that I guess when I'm looking at these kinds of numbers, that's one of the things that I try to pay attention to, particularly in the different segments of the business. And because I know that this is a big part of Microsoft's future growth story, it's definitely something to keep an eye on.
Do you have that pulled up? And maybe we can share it for people who are watching on YouTube. If you don't follow us on YouTube yet, you can search Investing for Beginners podcast. And we do have the podcast on there too. And if we have more visual episodes like this where we're looking at charts, it can help definitely to see when you talk about the decline in gross margin. Was it big? Was it small? A lot of times you can answer that visually. And to your point about being able to see it between segments, that can also be very helpful.
Okay, so when you look on Fiscal AI, you can switch from annual to quarterly down here.
Mm-hmm.
And so that's what I did. And I switched from normal, which is annual, and then I'm going to switch it back to quarterly. And when we do that, we can see that over the last, six to 7 quarters, there's been a gradual decline in the gross margin. Now, this is the whole business, so it's not just defined to the cloud part that we were just discussing, but it is showing a gradual decline in gross margins, which could indicate a lot of things, but it could indicate that they're struggling to find a product market fit, but pricing power, the costs are just a little bit higher than maybe the demand is right now. And as they continue to spend more and more on CapEx, you should probably expect to see some compression in the gross margins over a period of time. And hopefully that will start to rebound. And that's one of the things that I look at when I'm looking at a company like Microsoft or Google for that matter.
Yeah. And since my mind's still on vacation mode, I'm leaning a little more on AI than I normally would. So you all have to forgive me for that. But one of the things they did say, which makes sense, Azure, cloud, it's all lower margin than the other stuff. So if that's growing faster than like Microsoft Office, which is software, which has a higher gross margin, then that gross margin will naturally come down. And that might not be indicative in this instance of company as a whole having problem with pricing power. It's just if your cloud segment's growing so fast that those revenues are lower margin and growing faster, then you can see some of that reduce the gross margin. And that's what the summary said here when it was summarizing the conference call transcript and talking about how Amy Hood, the CFO, talked about some of that. It was attributed to that sales mix shift towards Azure and the lower Microsoft Cloud gross margin. So that can be a helpful way to kind of double check your thesis, or if you're in vacation mode like me and don't feel like doing super deep thought, that can be a great way to do it too. So
Yeah.
all in all, I mean, those are pretty positive. There's got to be some negatives in the report though. I mean, it can't all be rosy and cheery, right? So what I did is I like to get perspective, and if you can do this easily, then you can see how market share shifts over time, and that can sometimes tell you the competitive dynamics between companies. So in the charting feature, maybe I can pull this up now. My turn to share screen. So what I got here is you can put in the companies and then you can put in KPI metrics. So I put Microsoft's intelligent cloud with Google Cloud revenue with AWS revenue. And so Microsoft up 23% annually versus Google 28% and Amazon AWS 15%. Google growing the fastest, but like you can see in the chart, it's also the smallest. So it's coming from a smaller base.
Mhm.
Microsoft also, well, actually, based on the chart here, you can see in Q2 25, they've actually surpassed AWS, which is interesting. I know, I'm
Mhm.
sorry. AWS hasn't reported yet for Q2, but Microsoft's cloud is now higher than AWS was in Q1. So we'll see where AWS falls for Q2. But if it's really closing the gap. I mean, I'm sorry for people on audio, but we're talking about 16 versus 20. If you look back 3 years ago when you compared Microsoft's cloud to Amazon's cloud, AWS, and Microsoft's now closed the gap last quarter. It was 26 versus 29 with this new jump with Microsoft almost at 30 billion for the quarter. Be interesting to see how that compares to AWS. Well, I mean, regardless, right? You're talking about high growth rates. Pick your poison. Do you like Coca-Cola? Do you like Pepsi? At this point, there doesn't seem to be one dominant winner. I haven't seen anything in the research to kind of indicate that one would beat the other. And so it's interesting to just kind of watch it play out. But if you can keep the big picture in mind, to me as a shareholder, I just kind of see things as like, all right, things are going along, and obviously the high growth numbers are appealing. The but we're not counting on it because we bought the stock with a margin of safety, and so that's
Mhm.
hopefully the mentality, and that's kind of the way to approach earnings in a very very exciting industry.
Yeah, yeah, very exciting industry. And I think maybe something else to kind of point out a little bit too is the fact that when you look at the earnings of the company, typically, well, maybe a better question for you. How many times in all the companies that you've invested in have you ever seen a report that you're like, I am out?
Right. It's
Because
it's
it
very
doesn't.
few. Yeah.
Yeah. So I think the thing to keep in mind when you're looking at quarterly reports is that this is a snapshot in a very short amount of time, and it's not a. It can be indicative of things going really well or maybe not so well, but it also probably generally is not a okay. This is so bad, I'm out kind of thing. So I guess the point I'm trying to make is try not to get too excited either way, positively or negatively on an earnings report, and just kind of use it as a way to update your thesis as it's going along.
I'm gonna pull up CapEx just to see.
Okay.
I know that's been one of the worries, right, for
Mhm.
investors these days is how much of this CapEx is going to will any of this end up biting the companies? You have something as new as AI and cloud
Mhm.
and compute and all of that. With all that spending, is it something to worry about, right? So I'm gonna go, let's call it from Q2 2020. So we're looking at a 5-year period. CapEx a little bit higher than where that those revenue numbers were for the cloud
Mhm.
segments. I'll
Right.
go to 2022 because there was no KPIs for intelligent cloud for Microsoft before then, based on the way they did segments. So Microsoft's definitely increased CapEx at a greater rate than it has its cloud, but it's still CapEx is less than revenues. So we could
Mhm.
stack those bar charts if we wanted to kind of see that. Amazon's also spending more than their revenue, and Google even more so. So interesting to see. Google's actually spending more in CapEx than its cloud revenues bringing in. So that might be something about, is there CapEx outside of the cloud segment? That could be one factor. Second factor is maybe it's just the cloud segment's too small for that to balance out. Definitely when it comes to Google versus Microsoft versus Amazon, CapEx, Google's actually now spending more than Microsoft, which I wouldn't have. That's not something that was always necessarily the case, and now they keep kind of going back and forth between the quarters.
Is there anything else about Microsoft that you think is pertinent to look at as you're kind of just looking at more of an overview and trying to catch up on a business
Yeah,
or
it's a
this
good
particular
question.
business?
Yeah, it's a great question. I'm going to pull up my custom KPI metrics that I've talked about in previous episodes. And so, because we've talked about how CapEx is such a big thing, and obviously compared to cloud revenues, it's a big percentage. I like to use that CapEx ratio. So CapEx to revenue, we can look at that. You can see in the chart, it's kind of hockey sticked up and to the right. So that trend that started in 2024 has now continued into 2025. We'll see how sustainable that is. But I can also pull up, let's say, return on invested capital. And is that it's starting to come down a bit, but it's still at a healthy clip, 20%. The bullish person in me says everything's fine, right?
Right.
But a skeptic can very fairly say, hey, maybe this spend is a little too aggressive. So
Mm.
I asked kind of earlier, you summarize the transcript and everything sounds amazing. Double digit growth, growth in the mid teens, growth 30% for commercial or whatever it was. But if you see a continuation of these trends, at what point does it start to get concerning? And we don't have an answer for that yet. Kind of to your
Mm-mm.
point though, like would I sell after, let's say, ROIC plummeted and the capex was just too extreme and I didn't like it? Would I personally sell? Probably not, but would I use that as an opportunity to say, hey, maybe I need to redo a deep dive into the business and question whether I was too optimistic about their moat or management's capital allocation strategies? Those would be more of the utility behind looking at these numbers, looking at these trends. And luckily for Microsoft, it's based on the end of the fiscal year, so we can see those year over year trends. And yeah, not a great thing to see ROIC go from 24 to 20.
No, no, but it is also maybe not unexpected as you see a big increase in capex spend.
Yeah.
You probably would kind of expect to see a dip in return on invested capital. But like you said, it's definitely something you want to keep your eye on and see as they continue the capex spend wars with the big companies, including Meta. You want to see at some point you want to see that turn, right? You want to see the ROIC start to turn around and go the other direction. You want to see revenues, start to produce more profits. And if it doesn't, then that's when, and not just Microsoft, but just across the board, all the companies, you can start to question whether maybe the AI race, if you will, is maybe not as profitable as maybe we were led to believe. And that could be something to think about too.
It's a really great point. Yeah. Pulling up EPS and just kind of looking at that alongside, it's growing pretty nicely. So I wouldn't be too
Yeah.
concerned about it now. But to your point, like if there's a rug pull situation, yeah, that can be concerning. The last tidbit I'll add to Microsoft, just because I have to be the bull, still net debt free. So the fact that they don't have to lever up to do something like this, you compare that to a lot of different companies, a lot of different industries, they would kill for a situation like that. So Microsoft net debt free, spend away, spend away.
You're right. Right. And kind of to that point, I was reading yesterday about Meta's latest earnings call, which we're not going to talk about today. But one thing I do want to add is they mentioned they are debt free at the moment. And they mentioned on the call that they would be willing to take on debt to fund their AI ambitions. And so that's big news because they've burned through almost $30 billion in cash in the last couple years, and they went from 45 billion to like 12 or 13 billion in
Wow.
cash on their balance sheet. And Now they're talking about taking on debt to fund this, huge AI project. So it's definitely something to keep your eye on as we watch these companies kind of go through this.
Yeah. Super interesting.
Yeah, super interesting. All right. So now that we've kind of got caught up on Microsoft, let's take a look at another one. Let's take a look at Watsco.
Yeah. When we were trying to decide like which companies do we want to look at, one way, like I've mentioned in the past, you can go to the dashboard, click on news, and kind of see who has reported, and it's all sorted by date. Another way is just like, hey, where have stocks moved in the last week? And you can see for your own portfolio. And if I sort Watsco's second worst performer in the last week, that lends me to think, okay, maybe they had an earnings call. And sure enough, they did, and Wall Street didn't like it.
Hmm. Yeah. So if we go back to the investor relations tab and look at the AI summary of the quarterly call, we can see a few things that kind of jump out. Revenues decreased 4% to 2.06 billion in Q2, and gross profit also decreased 4% to a record 603 million. So those are a couple things that just kind of jumped out right away. Earnings per share was up, which is nice, and they still maintain a good good solid financial base with 293 million in cash, no debt, and 3 billion in shareholders equity. So yeah, those are nice things to see. So
I asked the AI what were the analysts nervous about. So one of the things I said, 4% decline in sales, even though pricing was up double digits, 4% decline in sales. You can excuse it based on the summer season, which was one of the reasons listed on here. But is it indicative of something that's more concerning? That could be something that Wall Street's worried about. And then they also ask questions about inventory management, the fact that it peaked at about $2 billion dollars, that there's a A2L refrigerant transition. So it's the type of products for the equipment that they're selling, the HVAC that they're selling. So that's a concern, especially with inventory turns now between 3 to 3.5, which is below COVID. I'm sorry, it's below the pre-COVID level of 4.5. Again, nice to see kind of all these numbers and not have to read through the pages and pages of transcripts. But
mhm.
that's something to look at, right? Inventory management. I've definitely held stocks like Target where inventory skyrocketed and it did not turn into revenue, and then the stock did really poorly for a long time after that. So
Mhm.
could that be a situation going here? Was it maybe just a valuation sell off? Those are all potentials for a company like Watsco.
Yeah, for sure. I have heard them mentioned, to pile on the AI pile, as they could, could they be a beneficiary of the build out on data centers and things of that nature? Would are they are they aligned in that area that could be a benefit for them?
I don't know. That's a good question.
I don't.
Okay.
I've seen people bandy about some different companies and refrigeration in particular as a method of obviously cooling the data centers because they get so hot. That could be a benefit to some of the larger um, refrigerant, air conditioning
Right.
businesses, i.e., Wasco, Train, Carrier, things of that nature. So I was just curious if they have ever mentioned that specifically.
Yeah, I mean they might have. It's not a segment broken out in their financials,
Mm,
so my guess is as good as anybody else's.
okay.
If you pull up inventory turns, which I can show, we see a pretty steady decline since there was a peak in 2021. So great inventory management then, and then that's starting to fall off. I'm also going to pull up just like price to earnings just to show it's it's definitely on the higher end. What's nice about these charts is you can add like an average line, median line. So let's do an average line. So the average over the last, call it 9, 10 years, has been around 28%, 28 on the PE, and it's out of 35. So you can see it kind of like peaked up in end of 24. PE got as high as a 40.
Mm.
If I'm in the surface, like again, we're looking at earnings to say, all right, does this need a deep dive, or is it kind of like steady as she goes? Because
Mm.
as an investor, it's really not practical to do a deep dive for every company, every single earnings call. What do you say based on some of these metrics?
I would say that there is probably at this point nothing to be overly concerned about, but maybe if you have extra time, maybe it would be behoove you to look into why inventory turns have continued to lag, because that's such an important part of their business that might be worthwhile to look into to see if there's some sort of industry pressure or if there's some sort of supply chain issue that they're having trouble with, and just try to get to the bottom of that. But it isn't anything like shockingly like would you call it rug pull like
Mm-hmm.
to say holy crap, this is something I got to look into. It's like, okay, maybe that'd be something I could put on my list of things to do at some point, but I wouldn't rush out and do it like tomorrow.
Yeah. I mean, I pull up gross margins. They look very solid. If there was
Mm.
one thing to nitpick, so I pull up gross margin, I pull up operating margins. If I were to nitpick something, to be SG&A to revenue is kind of ticking higher. But,
Mm.
in the context of 5-year revenue growth, which is high, one of the things I try to do to keep myself grounded when it comes to looking at growth rates is kind of zoom out over a longer term time period. So I like to kind of look at a 5-year and then see how that is moving from year to year, which is kind of a weird thing to conceptualize. But anyway, it works. If in my head, it works anyway. So still at like 8% over 5 years, which is a quite a nice acceleration from before the pandemic.
Yep.
So I say all that to say the tick ups in SG&A, the revenue, don't worry me too much, because while they're getting more aggressive in that spending, they are also seeing higher levels of revenue growth. So I kind of see it like it's paying off. Would I
Right.
want it to see it continue to tick up like that, higher, higher, higher? No, especially if it starts to impact operating margins. So that would be a metric. That's something I like to look at also as a custom metric that I pulled
Hmm.
up here.
How is the? Could you check on the free cash flow margin
Yeah.
and see how that's doing? I'd be curious how that's doing.
So pretty up and down.
Yeah, very up and down. Very up and down. That's fine. That's not unusual.
Anything else that would behoove you to consider for a stock like this?
You mentioned maybe net debt to EBITDA might be interesting to look at just to
Yeah.
see how they're doing in that regard.
Yeah. Debt free at the moment. They kind of hover in between, like just having a little more cash than debt, and
Hmm.
sometimes dipping under that. But
Right. Yeah, for sure. Are they a big buybacker of shares?
no, they just pay a dividend only. So
Okay.
one of the things we can look is their shares outstanding. I know grows a, at a little bit of a rate. Again, why I like looking at the chart, you can get the visualization as well as the actual CAGR number. So if we look
Mm.
at since 2020, about 1.6 a year that shares outstanding is increasing. So they're not doing any buybacks, they're issuing a little bit. So they're not offsetting the dilution from stock based compensation. So if I'm getting, if the dividend is, I think for Watsco, it's around 3 or 4.
Yeah, almost three.
Right now it's 2.7, and then you're losing 1.6 in dilution. You're still net gaining as a shareholder about a
Mm.
percent per year. So they are returning capital to you, even though you're getting slightly diluted, you're getting more than that in a dividend.
Yeah. Are there any KPIs specific to Watsco that would be something you'd want to check out?
Yeah, it's a good question. So we can click on the tab and it can show us some nice ones. HVAC equipment revenue percent as a percent compared to total. The idea being, that's kind of the bread and butter. We
Mhm.
don't want to see that decline unless they've explicitly said that they're kind of targeting other aspects of the business. I like looking at the average selling prices just to get a sense of, is there softness or is there high demand for the products themselves. When I bought Watsco, I kind of saw it as, which is weird because it hasn't performed this way. People have kind of bid the stock up like it's some great growth story. But when I bought it, I wasn't looking for much more than like GDP growth plus a nice dividend and then maybe some multiple expansion, which has happened.
Mhm.
And so with a story like that, GDP growth is pretty decent. So, and like 6% a year over the long term, I'd probably be happy with. And that's kind of how I looked at it. They're they're very interesting in that they are a big leader. So their industry is very fragmented. So when you have a leader that is that big and there's not really another publicly traded competitor who challenges them, it makes it a little bit different to analyze. So I mentioned how with the cloud companies we were looking at earlier, you can compare the three big ones and kind of see relatively how are they shifting. You don't get that when Watsco is really the only big dog. The only I guess the roundabout way to do it would be to compare them to their OEMs.
Mm.
So you compare them to like Carrier, Ream, some of those other HVAC OEMs, original equipment manufacturers, and you see is
Mhm.
the relative balance of power shifting. In other words, are they not able to? Yeah, I mean, best way to say it is the balance of power shifting. Is one side getting more of the value than the other side of this big value chain?
Mhm.
So that would be one way to do it. Not really a super easy KPI for Watsco to watch, but average selling price could be one, and then relative power between its vendors could be another.
Yeah, that's awesome. Yeah, that's perfect. So, I guess bottom line, looking at Watsco using Fiscal AI, do you see anything that are glaring red flags that make you think, okay, I need to put this on a list to do a deep dive into?
No, it doesn't go to the top of the list. It's I understand Wall Street will get jittery about any little thing. I understand where the concerns are, and sure, maybe they could get better inventory management. Maybe there is a glut in inventory, and maybe you'll start to see some of that kind of work its way and turn into bad future quarters. I'm not going to spend time trying to speculate between this quarter or that quarter, but if it does happen and you have a big kind of kitchen sink moment, then at that time I would definitely push them to the top of the list to look at.
Yeah, yeah, that's awesome. All right, folks. Well, with that, we'll go ahead and wrap up our overview of a couple earnings calls using Fiscal AI to help us kind of scroll through and see how the companies are doing. I hope you enjoyed this episode and I hope you see how helpful Fiscal AI can be to get you caught up on companies and to keep you on track and on top of the companies that you own in your portfolio. And if you are interested, you can get a 15% discount after a 2-week free trial at fiscal.ai/IFB. I will put that in the show notes, but it's probably easier to just rewind and check out fiscal.ai/IFB for a 15% discount. So with that, I'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.